All right. Hello and welcome, everyone. Thank you for joining us for this Profit by Design webinar. As you get settled, a few reminders. Please use the Q&A section for any questions today, and remember to be constructive in any of those questions or comments to the presenter and to one another to ensure that we have a session that is productive. Also, AIA California will submit one AIA learning unit for those who complete this session live. And as always, the webinar content and additional resources will be available shortly after this session. Today's engaging financial bootcamp style webinar is brought to you by BQE. And again, it qualifies for one AIA learning unit for those who watch live, which AIA California will report for you once you have finished the session in full. Now to introduce our presenter. As a distinguished thought leader, Steve blends his passion for design and firm management with profound insights into emerging technologies. Over the past 2 decades, working directly with over 1,400 firm owners, Steve has significantly contributed to reshaping these businesses for enhanced growth and sustainability. Steve's career highlights include a 7-year tenure at SOM Chicago, founding BB8 Architects in 1993 and growing it to a 17 architects before its 2007 sale. Creating Arca Office, a groundbreaking project management company acquired by BQE Software in 2010. Recognized for his significant impact on the profession, in 2009, Steve was elevated to the College of Fellows of the American Institute of Architects. Currently, as founder of the well-designed firm, he focuses on leading AE firms to operational excellence, mentoring leaders to craft businesses as elegant and innovative as architecture they create. All right, now on to today's presentation. Thank you, Steve.
Great. Rebecca, thank you for that. Let me go ahead and share my screen, which is a mosquito in front of me right now, but we'll go ahead and share that. Okay, terrific. I guess I got to move that out of the way. So thanks everybody for joining me today. And this is a boot camp, so you're going to need to strap in because we have a lot of things that I'm going to go over today. I don't think a lot of people realize this, but the most transformative investment that you'll ever have in your life is it's not going to be something that you get in real estate or investments in the stock market. It's actually going to be your very own business. And the key to unlocking unprecedented growth and profitability, if you have a business, it's already in your hands. So today we're going to look at, I think, more of a paradigm shifting concept about, profit in design and, a financial boot camp for AE leaders, or for those of you who are looking one day to open your own firm. Please don't think that looking at a balance sheet or a profit and loss statement is to be considered financial management. We're going to cover the fundamentals of your firm's finances and the management processes that you're going to need to enact to lead a firm responsibly. So it's not just about earning more money. It is about empowering you to achieve your dreams, be them financial dreams that you might have, or maybe it's really your dreams lie in just shaping, a legacy in the built environment. When you have the right financial insights, when you have the right strategies, there's actually no limit to what you and your firm will be able to achieve. I also know it's probably not what you all want to hear. We're all taught in school, we're going to be, designers. Let's learn about design and client service. And all you have to do is do that well, and you will be successful. This is not the case because first and foremost, you're in business. Now, as Rebecca mentioned, over the last 20 years, I've worked with over 1,400 firm owners who don't realize they are at the helm of a money printing machine. And not only do you need to learn your craft as an architect, you need to learn how to steward a successful business. And without proper financial management, your firm will never achieve its full potential. Much of my background has already been presented by Rebecca. I don't need to go through that. If you want to learn more about me, just go to the welldesignedfirm.com later today. Check that out there. but I have built three businesses and sold successfully three businesses. And I now provide consulting and coaching services to firm owners who are looking to, as was mentioned, build a business as elegant as the architecture that they create. Okay. I always ask my clients to reframe the purpose of their firm. Now, I strongly believe your firm itself is the most important project, that the most exciting project you will ever get to work on. It is a rare privilege to own a business. So I want you to treat it with utmost respect. Now, as architects, we typically will apply our design skills to somebody else's asset. And once completed, we can't return and make it better. We can't fix our flaws. But when you own a firm, you are not only able to continually improve it, but you're adding value to something for which you are the beneficiary. So, think of your firm maybe as a luxury high performance vehicle. It is what is taking you on this journey that you call your career. And as a well maintained high performance vehicle, your ride's going to be delightful. But if that vehicle is poorly designed, cheaply constructed, and rarely maintained, your ride is going to be uncomfortably bumpy. You're going to arrive at your destination exhausted, smelly, and certainly unhappy. So if that comparison isn't working for you, I will often reach for a sports analogy here. But if you want to excel and maybe even win against an opponent in sports, you need more than simply understanding the basics of the game. You need consistent practice. You need to maintain your physical fitness. You need to consider your nutritional intake, and you need to prepare yourself mentally. All prime athletes, or even any athlete that is striving to be their best, they are going to receive coaching. They're in the game and they're going to rely on a coach to observe what is happening, provide some constructive criticism, hopefully, teach them new skills, but most importantly, to make them accountable. It's very important, especially for sole proprietors who don't have a partner to help make them accountable, to work with a coach who's going to be there behind you, not just in support, but also in accountability. Um, in addition, a coach is always out there surveying the technology landscape and finding the best kinds of tools and techniques to help and enhance their edge of their athlete. And that is no different in business. It is important to understand how the game is played, understand strategy, but that is really just knowledge and theory. If you really want to play the game, you have to work hard. You got to get into shape, practice regularly if you really want to be a winner. Now, you're going to need to fine tune your skills from budgeting all the way to strategic investments. And when you have the right skills, that's when you're going to build a highly successful firm. That's when you're going to attract the right clients who will bring with them those dream projects. Okay, now whether you own your own business or you aspire to one day, I do want to talk to you about, again, this amazing opportunity that you have. When you have some money to invest, there's a lot of options. Even if you're working with a financial advisor, anything you invest in, whether it is, like I mentioned earlier, the stock market or bonds or real estate or cryptocurrency, precious metals, annuities, index funds, whatever there are out there, right? These are all things that are out of your control. And if you are lucky, over the long term, that investment is going to return to you 8%. And that accounts for inflation and a reinvestment of dividends. And yes, I understand there are some investments that might knock it out of the park, and we're usually all too late to get involved with those. But on average, all of us in the general population look to see about 8% of a return on our investment. But the nice thing is, of course, you don't have to think about it. Your money's working for you while you're sleeping. And I think we all should have a diversified investment portfolio. But if you are ambitious and you're smart and you're hardworking and you really will put in the effort, there's actually no better investment than your own business. And that is in spite of the U.S. Bureau of Labor Statistics that tell us that 50% of all small businesses will fail within the first 5 years. And 70% of them are going to fail within 10 years. But I will wager that you are in the top 30% of your class simply by virtue of your attendance here today. So don't let that dissuade you. And now, in a way, I want to kind of illustrate how a firm is the greatest investment that you could ever make. And I'm going to use myself just as an example. And I am not special, but I probably hope to be or think I am in the top 30% of my peers. But I did start my first firm, BBA Architects in Chicago. I did it back in 1993. I already had quite a lot of experience. I was 7 years with SOM, and I realized now is the time to go out on my own. I had been saving money, and let's say we just amassed, to make the math really simple for us today, $100,000. That's the money that allowed me to quit my job, go out on my own, run that risk, and help support me and my wife. And we were about to have our first child back then. Now, had I listened to my friend, who was a financial advisor, who said, invest with us, we're a brokerage house, we'll be able to, take care of you, my money would have earned an 8% interest with all of that compounding. Now, I'm using a 14-year period because I created the firm and sold it in 14 years, and I just want to use this as a comparison of how that money was put to work. So at the end of 14 years, that $100,000 investment would have grown to be just shy of $300,000. So the money's really tripled in value. Not bad. On the other hand, I put the money into a firm. I worked long, hard days. I worked a lot of weekends. I'm sure all of you are doing that. I will expect a much better return than a passive investment with a brokerage house. So over the same 14-year period, the firm experienced a compound annual growth rate, pardon me, of 27%. So that same initial investment grew to be worth just under 3 million, 2.9 million. So had I not created the firm and instead went ahead and invested with a respectable mutual fund as recommended by my friend, kept my day job, kept the job, and just everything would stay the normal, I would have experienced an opportunity cost of $2.6 million. So when you think about your business, please understand it has much greater potential than just allowing you to live a particular lifestyle. It can allow you to do things that you probably don't even imagine. And if your needs are very simple, think about how much good you could do elsewhere in the world with all the value that you have the potential to create through your business. Now, this is a boot camp. Again, one of my responsibilities is going to be to cover some of the terminology that we use when we talk about your firm financials. We're going to hit a bunch of those a little bit later. So there are dozens more we could talk about. I do have time just to talk about 16 of these today. And to make it memorable to you, I am providing a downloadable, let's call it a cheat sheet. It's sort of an infographic with very succinct definitions for all of these terminologies. If it's not available to you here, hopefully Rebecca's making that available to you. You can always go to the welldesignedfirm.com and get it on my downloads page later on. Don't go ahead and do that right now. So first up, we're going to talk about are two different accounting methods I think everybody here should be familiar with by now. It is the accrual base and the cash. So accrual means all the income, all the expenses are recorded at the time that they are earned or incurred. And it has nothing to do with whether cash was received or paid out. And accrual accounting will provide you, your firm, the best picture of your long-term financial health because it's going to account for all of your earnings and all of your obligations, not just those that have been settled in cash. And most firms will use this method for their own internal analysis. Now, the other one is cash basis, and it is what it sounds like. Income and expenses are measured when they are received or paid. In other words, transactions are noted when actual cash movement happens. Cash basis accounting, it gives you a direct view of how much cash the business has at any given time. And you're probably going to use the accrual method regularly. The cash is very often used when calculating your firm's tax liability, not always. That's something that you and your tax advisor should decide because once you make that decision, you're pretty much going to be stuck with it for the future. The next couplet refers to your revenue. Gross revenue is the total income your firm earns from all of its sources. And for most of us, in the architecture industry. The bulk of that is going to come from the fees we earn through our professional services, but you'll also get some revenue for billable expenses or reimbursable expenses, maybe even a markup that's related to those expenses. Maybe some of you figured out a way to sell some products, okay? And you'll earn some revenue from that. So gross means the full kit and caboodle before any expenses are deducted. And then it comes, of course, net revenue. That's what we refer to when we talk about your bottom line. So to calculate your net revenue, you just take all that gross revenue and you subtract out all of those expenses that are directly associated with your project. So those are your labor costs, any materials, any consultants or subcontractors, direct expenses, which we'll actually get to, travel, printing, you name it. So what did you have to spend to earn the gross revenue? So next up, I have a lot of couplets here, is direct labor, also known as direct salary, and that represents the costs of the time that is actually ends up being charged to projects. And it has nothing to do whether that time was invoiced or not, okay? And it includes the time of your principals. And then the indirect labor, also indirect salary, that's the cost of all the time that is charged to everything else, non-project related activities, and again, including your principals. You know, administrative tasks, paid time off, training and professional development, marketing or business development costs. Maybe some of you do some research costs will be associated with that. Quality control, maybe peer reviews, office management, human resources, financial management. That's all indirect stuff. So direct is to projects, and indirect is everything else that's not being given to a project. Now we got that clear. Direct expenses. Those are any and every project-related expense. Those are the consultants, and it has nothing to do whether they're billable or not, reimbursable or not, and regardless of the contract type. But if it's a consultant that's doing some work for you that's related to a project, we're going to track that back at the project or direct costs. And those indirect expenses is everything else, general administrative expenses, you know, your rent, utilities, indirect labor, insurance, things of that nature. And understanding what is your firm's, what is the indirect expenses, that's going to be vital for some financial planning. And we'll see more about that in a couple of minutes. So we're halfway through the list. Next up are your reimbursable expenses. Those are project-related expenses that end up being invoiced to your client. And that is in addition to whatever service fees you have. And typically, hopefully, you'll include a markup on that somewhere between 10 and 20% is very common. And you also recognize that as revenue. That's all part of your gross revenue. Now, in my experience, by the way, that is an area where a lot of firms are weak, getting a reimbursable markup. So you leave some money on the table there. It's also an easy win for firms where profitability might be suffering a little bit. Another couplet. And you have to become familiar with these two because they resonate throughout your business. The overhead rate is this, it's essential for your firm to understand the indirect costs associated with your company's operations. It is a key part of pricing your services accurately and ensuring that you're going to be profitable. So the rate is really the ratio of what are our total indirect expenses to our total direct labor. So if your overhead rate is 1.75, which is just a common rate in the AE industry, that means for every single dollar that you spend on your direct labor, it's going to need another $1.75 to cover all the back end overheads costs that you need to support your business. And knowing that overhead rate means you can accurately estimate the project costs and then set your fees. It's going to ensure you're not just covering all the costs for the team, you know, the architects and engineers, whatever you might have working on your project, but also all those indirect costs of running the business. And that is crucial for maintaining a healthy margin. Now, the break-even rate is really just your overhead rate plus the unit of one. Why one? Well, one represents a single hour of someone's salary. So As we just described, if the overhead rate is 1.75, that means your break-even rate is 2.75, right? For every dollar of salary, your firm must earn $2.75 just to break even, okay? And to make this come a little, maybe a little bit more alive, if you total up all the salaries for all of your employees, and let's say it equals $1 million, make math easy here, your firm's going to need to invoice $2,750,000 before you can even hope to see a profit. That would be your gross revenue. Now, the break-even rate is basically it's a multiplier. So if, for example, you estimate what's all the direct labor costs for a project. I know all the people who are going to work on it. I know what they cost me for every hour of their time as a business owner. You totaled all that up. Well, let's say it's $50,000. If you wanted to break even, you're going to need to multiply the $50,000 times 2.75, and that's about $137,500. And that again, that's your fee from your client. That does not include any profit yet. There's another couplet coming up next, utilization and realization. I think everybody here is going to be familiar with utilization. That is comparing your direct labor or your billable hours, and it's expressed as a percentage of the total labor. And a lot of firms recognize this is like really critical for understanding how is the staff's productivity or how efficient are our projects. Now, for an individual's utilization rate, we're going to use their hours. For firms, we're going to use the costs of those hours. A firm might look at a rank and file technical employee, and they'll set a target utilization rate like 90%. Or they might look at a principal and say, oh, they're going to have a target utilization rate of 55%. And you're about to see in just a moment, feeling good that an employee is actually hitting their target utilization rate is actually only half of the story. I don't ever look at a utilization rate without also looking at what is called a realization rate. Now, this is a term I think most of you are unfamiliar with. I do think it's more important than utilization. It really tells the end of the story. So, unlike utilization, it isn't reflected as a percentage. It's actually referring to the average hourly rate that is billed and collected for every hour of an employee's work. And you're going to compare that to what is their standard billable rate, assuming that there might be a moment when they bill out hourly. Some of you, I'm sure, have figured out a way not to do hourly services. You're never going to understand the realization for an employee without using technology similar to today's sponsor, BQE Core. So imagine you have an employee who, when they bill hourly, you expect them to earn you $165 an hour. But their realization rate is going to might end up being $180 an hour. And you're going to be excited because they're bringing you 15% more revenue than you had planned. But you can also be very unhappy if you find out, oh, look at that person's realization rate this month or this period was $132 an hour. So they're underperforming by about 20%. And either of those cases will be true, but the utilization rate will look exactly fine. And maybe they're even hitting that utilization target. That's why I say utilization just makes you feel good that people are like working on projects, but is that work they're doing actually bringing in you money? And that's where realization is phenomenal. So a net multiplier, that is the ratio of your net operating revenue to the cost of all that total direct labor. And it's really a measure of profitability and efficiency of how your firm executes your project. So when you understand your net multiplier, that's how you can also determine some pricing strategies and what is really the value of the work. And then you can measure your efficiency of project management and how well is our labor being utilized. So a common multiplier in the architecture industry is like 2.2. That means that for every dollar spent on direct labor, your firm is generating $2.20 in fees. Okay. And that's critical for your firm's profitability. Okay. The higher your net multiplier, that's going to suggest better profitability and probably in a very efficient use of your labor. So it's a clear indicator of how effectively your firm is applying its design and operational skills to its business model, making sure that the right talent and the right effort by your staff is being actually translated into financial success. And when you do use the right technology, these numbers, which might look like, hard for you to figure out, or you got to run some spreadsheets, they're unnecessary when you use the right technology. The last two are a little bit fungible. I know different firms will use different variables, but this is how I look at your business. So your net profit, you might call it your operating profit. That refers to what is the money that's remaining after you take out all the direct and all the indirect labor and all the direct and indirect expenses. It's the amount of money before your firm decides to make any distributions to the shareholders, the partners, or make any tax payments. And the last one would be your current earnings, which is the net dollar amount after all those distributions are made and any taxes are paid. And how you define those are going to vary whether your firm is a C Corp or an S Corp or an LLC or an LLP. And there's a lot more we could talk about if we had more time: EBITDA, retained earnings, which I will get into in a minute here. But take the 16, get that little cheat sheet, keep it at your desk if you're not familiar with this stuff. Now, before I take you into 5 of the financial reports that every firm owner has to know, we have to talk about the undeniable yet often misunderstood chart of accounts. This is essentially the backbone of any accounting system, and it directly feeds into the creation of a balance sheet and a profit and loss statement. Now, I do have another phenomenal downloadable document. This is because when you download this, you're going to be able to zoom into that, which I'll show you in just a moment, and see what is the breakdown in this ideal chart of accounts for any architectural firm. And get that here at a link that's probably being passed to you through Zoom, or go to the welldesignedfirm.com later and go to my download page there, and you can go pick it up right there. A proper chart of accounts uses this numbering system that is as well considered as the system that we're all probably familiar with from the Construction Specifications Institute, right? Numbering system is really critical. Too many firms I look at have their accounting software with the numbers turned off, and that does not allow you to look, as you're going to see in a few minutes, quickly and understand the meaning of what those categories are. So the first 3 sections, and that's highlighted in the on the right side there, the upper portion of the infographic. That's highlighted in red there. That's all of the information that's going to flow onto the first report, which is the balance sheet. So the thousands, those are your assets, all the things that are listed in the 1000s category. What does your firm own? There could be cash or cash equivalent accounts, your accounts receivables, that's actually something you own, and some fixed assets. Maybe you own a building or you have some equipment, okay, that you own. Like a large format printer, which we'll talk about a little bit. Then are the 2000s. The 2000s include all of your liabilities. What do you owe? Like, do you have any loans, like a mortgage maybe, or some accounts payables? Those are your pending bills that haven't been paid yet that you owe. And then the last thing are the 3000s. That's your equity. That represents the owners or any shareholders' interest in your firm. And that includes what I mentioned a moment ago, which is the retained earnings. What is that? Those are the profits of a company that have not been paid out to shareholders. And you have to become familiar with that term, retained earnings, because it represents your firm's capacity to self-fund your growth, which will give you stability. A lot of architects will typically focus on just projects, but when you understand and you can manage your retained earnings, that is key to transitioning from just project level profitability to a mindset that considers your overall business's sustainability and growth. There's also a common misconception that I see. Firms look at that big number that's in their retained earnings, and they think that they should have some cash or cash reserves in the firm that balance that out. When your firm sees a large amount of retained earnings, but a smaller amount of cash, you wonder, where did all that money go? So those are profits that are typically reinvested in various forms. Could be some new equipment, paying off some of your liabilities or debt, Maybe you're putting it in R&D, maybe investing in software, technology, which is critical for managing the company and managing your projects. When you have higher retained earnings than cash or cash equivalents, that means your firm is focusing on its long-term growth and your sustainability. And again, technology, equipment, human resources, rather than just distributing that money out as a dividend to an owner. So feel good about that. Don't feel bad. My belief is that every dollar your firm is spending, that should provide a return on investment. So you need to be really thoughtful about where you do invest. So you do get some long-term benefit. If you had $50,000 in cash at the end of 2023, you might think, oh, we're just going to distribute that to the owners of our company. But you might also say, hey, let's invest in something. Let's buy some new equipment, or invest in training, or get some new software, whatever it might be. Okay. When you have that discussion, please understand that that $50,000 is now an investment, and it needs to bring back a lot more than $50,000 in the future. Otherwise, you really just threw $50,000 away. Also, what equity is for you is essentially it's the value that would be returned to any of the company's shareholders if everything was liquidated. If you were one of those, firms in the 50% or 70% that failed within the first 5 or respectively 10 years. So next up are the accounts in the lower half of the cheat sheet there, the infographic, that end up being represented on the profit and loss statement. So everything in a chart of accounts ends up either in the balance sheet or, as we're going to see now, in the P&L. So the first category, the 4,000s, that's all the income from any of your business activities, service revenue, and as some of you who figured out how to make some money while you sleep, any products that you might be selling. The 5,000s, those are direct costs. Anything your firm incurred, any costs that's attributable to the production of the goods, or in most cases, the services that you are selling to your clients. Direct labor, reimbursable expenses, any other direct expenses. And when you subtract from the revenue, the direct costs, that's how you get your net operating revenue. I should also mention, by the way, that this typically comes up in a discussion, is how do you deal with an employee who works both on direct work and they have some, indirect work? How do you manage that? Well, when you do use great software products, that is going to be handled for you in the background. But when you don't, I would simply say, if it's too much effort for you without the technology, then go ahead and just say a technical employee is going to be direct labor, and an administrative type employee, someone who works, let's say, less than 50% of their time working on the projects, should be just considered indirect costs, and things will work out fine as long as you're consistent that way. So next up are the 6,000s. Those are your operating expenses, or those indirect expenses we talked about. It is the most detailed section of your chart of accounts, because it's going to categorize all business expenses that are not related to projects or services. Here you're going to see payroll, rent, marketing, insurance, legal and accounting services, the whole other bunch of items there. But you can see, if you get that thing, you can zoom in and see all the categories I have for you. Next up are the 7,000s. Those are other expenses. So those are rarer expenses, maybe bad debt, maybe some interest expense that you have to pay on that line of credit that you might have. Depreciation, amortization, bank fees, loss on assets. So you and an accountant, your accountant, need to really discuss which expenses are considered normal. Those are going to be up in the 6,000s, and which are unusual. They don't play a role in your firm's day-to-day operations. And then lastly, we have the other income. These are things that really you will earn some money on, but they're not core to your business. Maybe it's interest earned, or maybe there's a gain on an asset like a money market account that you've parked some money in. It could also be some rental income that you might be receiving. Maybe you own a building, your office is in the building, but you also have a tenant, and that is not really core to your business. So we're going to consider that under other income. So that's it. You got the full array of all the sections from the chart of accounts and how they end up being manifest on the two most important financial documents for any business: balance sheet and profit and loss. Now, here I've just gone in and zoomed ahead. So if you do download that, you're going to get an idea of what you will see inside of that. And notice how I have the account codes on the left, just like the CSI numbering system on the left. And then I can go ahead and name, and the names are, for me, not as important any longer because I do know my numbering and where they belong and what their meaning is. Okay. I'm only going to talk about 5 reports today. We already touched a little bit, but I'm going to go a little bit more on the balance sheet and the P&L. We're going to talk about the cash flow statement. We're going to talk about an accounts receivables aging report. Don't just get an AR report. You need the aging report. And lastly is the least used report for firm owners that I experience, that I know about, which is the ability to report on the financial budget versus the actual. And I have to impress upon you that you trying to get that kind of information using spreadsheets, this is just about the worst way to run your business. If you're doing this, it would be the equivalent of doing all your projects with not drawing with CAD or BIM software, but using vellum and ink, on a drafting table, right? That's a bombastic way to operate your firm today. So this is true whether you are a sole proprietor or you have hundreds or thousands of employees. Please use technology. Do not attempt this manually. It's a colossal waste of your time, highly inefficient. So you should be using software, again, like today's sponsor, but there's others out on the market as well. Use technology. It will be accurate. It's going to be in real time. And my favorite is it's going to be automated. And there we go. So we're going to start again with the balance sheet. That's that snapshot of what is your firm's financial condition at a specific moment in time. And understanding this is key to understanding how the liquidity of your firm or the solvency of your firm is. What's your overall financial health? So you're going to see each row again starts with a number, and that's coming from that chart of accounts. These are all chart of accounts, but the only thing we have added to them is some money at the end on the right side of that. So the thousands, that's all highlighted in green, that is what your company owns. And the upper half of the green area is showing those current assets. So those are your bank accounts. And then it's going to have some outstanding balances from some unpaid invoices. That's your accounts receivables. And that's why we're going to look at that AR report in a moment. There's also an area for you to track work in progress. Can't do this without technology. That is the billable value of all the direct labor and direct expenses that haven't yet been passed on in an invoice. Once it's an invoice, that's going to be moving out of there into the accounts receivables. The lower half are these long-term assets. You'll have computer equipment, furniture, and you're going to have depreciation and amortization as well included in that section. Then the 2000s, the red section, those are your liabilities, what you owe. Unpaid bills, some unearned incomes, like your client might give you a retainer when they sign your proposal. That's actually unearned income. It might be sitting in a cash account on the left side of the screen. You might have a bank account that's for retainers only, or you blend it in if you're not being so careful. But that has to be balanced by the income that has not yet been earned for that. You'll apply it in the future, maybe at the final invoices. Also, some pending payroll can be showing up here. You'll also see the balance of any of those lines of credit or any other loans that you might have. And then the last section, again, as the balance sheet has, is the equity, the owner's stake in your company. And again, you're going to be able to see that full list by getting that downloaded sheet, the PDF, the cheat sheet. And notice how the total assets at the bottom equals the total liabilities. And that's because it's a balance sheet. And that is the backbone of a double entry bookkeeping system. Every transaction affects at least 2 accounts that are in the general ledger. If your firm takes out a loan, that's going to increase your liabilities, but it's also going to increase your cash. That's an asset. And if the owner invests more money into the company, that's going to increase the asset of cash, but it's also going to increase the equity, which is going to be in the right page on this 2-page report. I love how I conveniently broke it up into two halves so you can see how it balances. Here's the profit and loss. I'm not going to take too much time on this. We kind of covered it earlier, but there's the 4,000s. That's all of your revenue. There's the 5,000s in blue, all those expenses. The 6,000s, that I told you was a very long list of all of your indirect expenses. And that also has at the bottom some 7,000s, which are your other expenses. And then there's that little section in green because it's money in, and that's your other income. And unlike the balance sheet, which will give you a single moment in time, the profit and loss is going to cover a specific range, a period of time. Most firms will look at it monthly, quarterly, and annually. And this income statement provides insight into your profitability. It highlights areas of strength, and it also identifies for you areas where costs can be trimmed. So you don't just print it out and look at the bottom line. Now, here we can see that the firm is experiencing a 26% profit. They have a gross profit of $958,000. And after all of those expenses and a little bit of other income, and a little interest earned, there is a net income of $252,000. Now, I just put that little arrow out there. But in previous webinars, if you've ever attended any of mine before, I've touched on a really crucial aspect of understanding that notion of having an investment on return. Whenever you spend money, I want you to see you're getting some money back from that. So this is a practical tip. I want you to diversify your chart of accounts to reflect your firm's very specific investment. So this example here now, I'm going to say, suppose your firm invests in a large format printer, common scenario. So in this scenario, I recommend setting up this dedicated account number 4315. It's coming in under income because we're going to get some money off of reimbursable expenses that is related to project-related reimbursables. And at the very same time, you need to establish a corresponding expense account. And we're going to call that 5315. So 4315 relates to 5315. And that's going to be cost of sales, project-related reimbursables. And why am I doing that? It's more than just a little bit of bookkeeping neatness. This is an approach that will give you a crystal clear view of the specific financial impact of that single investment. So in this case, a large format printer, this method will reveal something fascinating over time. That printer's contribution to your firm's bottom line will probably outshine even your most productive employee. It is a powerful insight showing you how some strategic investment in technology can be a game changer in your business operations. So in my own experience, I have seen the large format printer costs for a firm might be about $1,000 a month to operate. You fill it with paper, that has a cost, any ink, any maintenance that's, applied to that printer, but is bringing in $4,000 a month of reimbursable income. And one firm actually joked that they should just fire their employees and become a print shop. A little behind schedule here. Now, the cash flow report is a crucial financial document that gives you a detailed view of how cash moves into and out of your business, again, over a certain period of time. And when you understand this, it's going to give you much better control over the management of the business. It's a very simple report to identify the categories that are infusing your company with cash and those that drain your company from that hard-earned cash. At the top of the report, we're going to see there's a starting balance of cash. So whatever the date we run this report, it looks at what was previously in the cash amounts. And then at the end of the report, we're going to see what is the ending balance of cash. I'm going to give you 5 tips. More important than the report alone is the tips to improve your cash flow, because cash is king. So you should be interested in things that we can do to improve cash flow. And that includes, billing and collections practices, maintaining some cash reserves. So over the past 2 decades, as I've worked with over 1,400 firms, most of them have been creating their invoices manually. Small firms would report it would typically take them about 3 days every month to get all those invoices out the door. When we introduce smart technology, that is reduced from 3 days down to 3 hours. So use the technology not just to save you time, just also automate the process. That's going to save in time and errors, and it's going to make it easier to implement something I'll talk about in a moment called staggered invoicing. Offer your clients easy and flexible online payment options. The easier it is for your client to pay, the faster you're going to receive that payment. So here's a few things to consider regarding a billing practice. Instead of billing all of your clients at the end of the month, which I think almost all of you probably do, consider staggering invoices throughout the month. I don't mean bill your invoices twice, your clients twice a month. Just pick half of the clients, bill them in the middle of the month, and the other half of the clients, bill them at the end of the month. And that will smooth out your cash flow. Most of you are paying your payroll twice a month, but you're billing your clients once a month. And you can see just by virtue of that frequency, there is an imbalance, and you will, on occasion, have cash flow issues meeting payroll. Issue invoices immediately upon completion of a milestone or at a regular interval. So if it's the 5th day of the month and you finished a milestone, consider invoicing your client at milestones instead of waiting for this regular period. Especially helpful during fixed fee invoicing or stipulated sum invoicing. If you delay the billing, that's going to delay in payments. That's going to impact cash flow. Not only ensure that the payment terms are clear and agreed upon upfront, and standard we see is a 30-day terms. That's common, but please consider maybe either offering incentives for early payments, but considering that electronic invoicing and payments are pretty much ubiquitous today, I encourage my clients to change their terms to due upon receipt. No longer do you have to wait for an invoice to be mailed and take 4 or 5 days to get to a client. Then they get around to opening it. Then they write a check and it goes back to you. That's a good reason to have 30 days. They're going to put it on the Pony Express and get to you. They can receive it, review it, and pay it all that day. And then implement a system for following up on the outstanding invoices. A gentle reminder before the due date will encourage a timely payment. Also, keep enough cash on reserve to cover at least 3 payroll cycles. That's a nice buffer against any late payments or any unexpected expenses that you might have if you're not doing the report that I'll talk about in a couple of minutes. And it takes a lot of the stress out of it when there's cash in the bank and you know you're not going to have a sleepless night trying to figure out how to pay a bill. And regularly review and manage your expenses. Clients who value your services are much more likely to prioritize your invoices. So communicate with your clients about their billing cycle preference. Understanding their payment cycles from their end, especially if it's a business, that's going to help you then decide when to issue your invoices. So you don't issue it on the first day of the month, but they don't pay until the last day of the month. You can change your cycle so they receive it just in time, a few days ahead when they do their payments, and that will mean you don't miss their payment cycle. Cash flow forecasting. So what are we going to need? What big expenses are coming up? Identify where your shortfalls might be way in advance so you don't run into these problems, and have some scenario planning in case there are these eventual hiccups. The accounts receivables aging report shows what are the balances that are owed by each of your clients and how long those balances have been outstanding. And that's important to manage cash flow and to identify some issues with clients. Maybe the project's not being managed well. There's a reason behind not paying an invoice. So here's some benefits to running the AR aging report. So the primary benefit is its role in managing cash flow, which we just talked about. A lot of firms have very high overhead costs, and you need that steady cash flow to manage all your expenses. So the aging report's going to help you identify which receivables are due or past due, and then you can plan accordingly. Understanding the payment behavior of your client is also crucial. So when you use smart technology like I recommend from our sponsor today, it will actually tell you what is the normal aging date for their invoices. You might find a client is averaging 65 days to pay an invoice. That's going to need you to change maybe how you work with that client or have a conversation with them. This report makes it really easy to find what are the overdue accounts, delinquent accounts, if you will. And if you follow up with these um, early enough, that's going to increase your likelihood of collections. Anything that's over 90 days is almost uncollectible. So you might end up having to write that off at some point. Um, so it's not just enough to know who owes you much money and how old it is, but also this report is nice in that we're displaying who is the project manager. And so these reports can actually be sent to the project managers where they only see their clients and what it's looking like, because they're on the front lines managing this on a day-to-day basis. And when they understand invoices aren't being paid, especially in smaller firms, those managers are critical to helping make sure that that client is happy and is going to pay their invoices. And using technology also important. Uh, so I'm going to move on here because I want to get to this last report, which is the budgeting and forecasting. As the leader of a firm of any size, it is your responsibility to plan for your voyage. You wouldn't plan a road trip without knowing where we're going, maybe having a map or better yet, a GPS system that's going to help get you there. You're going to ensure your car is hopefully well maintained, got enough air in the tires, got enough fuel, whatever it is, before you head out. You have to do the same with your firm. The goals that your firm might hope to achieve in 2024 is going to require money to fuel the drive for that journey. I know the quarterly report that I have on the right hand of the screen here is kind of hard to read, so I'm going to enlarge just a little section of it for you first here. So earlier, when we looked at the profit and loss, we weren't just looking to see if there was a profit or if they're looking if there was just a loss maybe that month or that quarter. It's about understanding how every one of those line items on the profit and loss contributes to your firm's overall financial picture. And the true insights that you're going to get from these reports is why, understanding the why behind these figures, not just feeling good or bad about it. Now, in a moment, I'm going to share the budget versus actual report, which should be reviewed no less than every single month because it's going to identify trends or patterns. That's why we have KPIs, key performance indicators. We want to see what's going on over time, not just a KPI at a moment in time. It is not unusual for your firm to exceed a budgeted expense or fall short on a revenue expectation 1 month or 2 months, in a row. But if you do so month after month after month, that's going to indicate that there's something wrong operationally with the firm that needs some change. And certainly your budget's going to need to be re-examined, and your goals might need to be re-examined. Every single financial decision and outcome has to be aligned with your firm's goals. So unless you specifically budget the funds needed to fuel one of your goals, the likelihood of that actually ever being manifest is greatly diminished. Technology is available to make financial planning and reporting a breeze. Spreadsheets, again, are not the answer. You have to implement some smart accounting software to make and by the way, all of these reports are coming out of today's sponsor, BQE. So here we're looking now at that firm's financial budget, and we're going to compare it to the actuals. And doing this tells us how our firm's operational efficiency or financial health is going. The red text is telling us in this report something that is deviating from what we expect, and it's going to require more closely looking at it. And it's going to show us in red both the good news and the bad news, because they're both going to give us some insights and tell us what are our opportunities and what are our challenges. Again, remember that your firm's that vehicle that's making the journey possible. So ensure you have the money to afford the fuel and the tolls and any other expenses you need along the way. Establish your goals for 2024 and determine how much money you have to spend. If you're trying to increase, new client acquisitions, increase the rate, something in the marketing, area is going to need to go up and spend more money. Otherwise, it's just not going to happen on its own. That's the fuel. If you can find ways to expand your income from just providing professional services, this is like a tip here, that's going to also help make your firm more resilient. So look at the services that you offer today. What services can you provide? Or maybe even what products can you provide? It's not unusual for members of the AE industry now to think about packaging products to their client base, not just services. The last topic actually requires its own boot camp. We talked about a sports analogy earlier. I like to think of your firm as a sports team aiming for a championship. Every project in your firm is like one of those individual athletes on the team. And if you want your team to win, everybody has to be at their best, training hard, refining your strategies, understanding their specific role. Everybody in your firm's got a role, right? Similarly, every project requires planning, and it requires efficient execution and cost management if you expect the project and then the firm and by roll up to be profitable. So just like your athlete prepares for game day, project managers need to ensure that every aspect of the project is organized and budgeted. So if one athlete underperforms, maybe it's inadequate training or bad strategy, it's going to diminish your team's overall chances of winning. And if a project goes over budget or doesn't meet its objectives, it's going to negatively impact the overall firm's profitability. So again, just like that sports team's success hinges on this collective effort and the performance of every player, the success of every one of your firm, the success of your firm, it's the cumulative result of all these well-managed projects. And every project managed effectively is a step towards the championship. Anything that's not managed is a lesson learned. And then you change a process, a system, improve the training. You invest in making that problem not happen in the future. So here are 7 essential tasks your firm should follow for this kind of successful cost management. Before the project begins, before you submit a proposal, create a detailed budget. That should include all the expected costs like labor, materials, contractors, consultants, any additional expenses, direct expenses. And a thorough budget will set a very clear financial roadmap for that project. Use some of the historical data from past projects to refine what is this estimate going to look like, right? Just like you do with your clients' construction budgets, have a contingency for your own fees, because there's going to be something unexpected that may not be recouped in a additional service approved by your client. Implement a system for regularly tracking project expenses and the schedule and the deliverables. Compare budget versus actual, plan versus actual, whatever that might be. Allocate resources efficiently in the firm. Understand which people are best used for which projects or which tasks, and then you use the technology to make that happen. Make those financial reports available to any stakeholder, project managers, even the team, firm owners. Everybody can get these reports. They can be scheduled, so nobody needs to manage those. I'm running up against the clock here. Have a process for managing those change orders I mentioned. Okay, change in scope is going to significantly impact your costs. So have a process in place for tracking that and making sure your clients sign off on that, and you have fees to support that. Maintain clear communications with all the stakeholders on every one of your projects. The internal team, the bigger team, your consultants, the clients, their associates, whatever. Everybody needs to be tracked communication-wise so that there's no lapses in understanding, and utilize project management technology software for time tracking and project scheduling. Technology will offer you insights for analytics for better decision-making. With that, we're going to get a Q&A. I hope we can stay on a little bit longer. I've got 50 seconds left, but I'm happy to stick around, Rebecca, if there are. I just want you to know there's a poll question that's about to be launched for you. And I would just encourage you, please, no matter what your state your firm is in, whether you got technology you love or you have nothing but spreadsheets, please take a few minutes, respond yes to the poll question so that the folks at BQE Software can follow up with you, talk to you about your firm, your unique needs, show you how core might make a difference in your firm. I certainly would appreciate it. I know those folks will. So Rebecca or maybe Emily, do we have any questions? I'm happy to answer.
Yes, we do. Thank you so much, Steve. As you just said, make sure you fill out that poll and then go ahead and ask Steve a question in the Q&A. We do have a couple, so let me get started real quick. First question is, do you think that firms should hold savings for 3 to 6 months of salary or for unexpected expenses or a big marketing effort rather than distribute or reinvest all earnings?
Yeah.
How much savings to hold?
Yeah, well, that's a great question, but it is certainly you should have no less than 3 months. I think 6 months is terrific if you can manage to swing that with your cash flow needs. You should, as far as the principals go, have a baseline for what a principal needs to bring home, not wants to bring home, to uh, make it worthwhile for them. Don't overcompensate the principals until the year end, and then you can uh, basically pony up what you're really hoping to do based on how your performance was. Employees, definitely you're going to want to regularly, I recommend no less than twice a year, consider bonuses. Don't just make like a Christmas bonus or a holiday bonus based on performance. That helps keep them engaged a little bit more. But yes, you're going to have marketing costs or something unforeseen. So rather than have it go out into the partners' hands and into their bank accounts and then have to claw back that money later because something major happened, or you didn't hit your revenue targets, but your expenses you hit quite well. Yeah, so 3 to 6 months, terrific. Don't everything else beyond that, I'd say, depending on what your goals are for the year, you might want to um, uh, hold that money still in a savings account of some sort so that you can achieve those goals. So yeah, start your year with planning out the goals for the year and then funding those.
Perfect, thank you. I'll do one more question here. Uh, this is from our good friend Douglas. Do you include PTO and utilization?
No, no. So if your employee has a 40-hour work week and they are gone one day that week, the best you could hope for would be an 80% utilization rate for that month because their PTO is a indirect. It's indirect time. It's just yeah. I want to do it for the project. So Douglas, if you want to take that offline and argue that one with me, but no, I would say pay time off is indirect time.
Perfect, thank you so much, Steve. I'll throw it back to you or Rebecca.
I can take over and also say thanks so much. Thanks, Steve. Thanks, Emily. Thanks, BQE. Thank you all for joining us today. We'll give you back your afternoon and we'll go ahead and wrap this up today and we'll send you your AIALUs if you finished in full. And we'll see you soon, Steve. Thanks
Thank
so
you very
much.
much, Rebecca. Thank you, everybody. Appreciate it.
Bye, everyone.